Welcome everybody to another Pepperstone Learn It Live webinar. We're in July now, and tonight we're going to be talking about how to scalp a range-bound market, an often requested topic. And I think we have quite a unique approach on it, and there's a multitude of different things that you want to know when it comes to range-bound scalping. How do we define a range? How are we going to trade within that range? Are we going to have a bias either way within that range? We'll answer a lot of those questions tonight, so I think it'll be good. My name's Thomas Atkinson from FX Evolution. I'm joined as always by Tyron Abella. Hello, Tyron. How are you?
Hey, Thomas, and hello, everyone. Welcome to tonight's edition. It's scalping, so it's everybody's favorites, and range-bound markets are just so fun to scalp because everything is generally predetermined and really easy for take profits and stop losses. So can't wait to get into it and show you some of the things that we do on an everyday level, especially in today's markets.
Just going to quickly check, sound check just for everybody, just to make sure it is working. If it is, could you just post in the room in the comment section just to make sure you are hearing us clearly. As that's coming in, I'll just do the risk warning for tonight. The information contained in this video or webinar is generic in nature and for educational purposes only. The information does not take into account your personal objectives, financial situation, or needs. And the information is not going to be construed, of course, as an offer, recommendation, or solicitation to buy or sell or even participate in the markets. So, Tyron, as we've been talking about a lot through this crisis period when so many people have gotten interested in trading, which is awesome, and I think it's amazing to have this lifelong skill, we've had some rooms open. So we've got the Pepperstone Telegram room that if you aren't a member of, you definitely should follow that link there on the slides, and we'll have this recorded, and of course we'll upload it later on. And then the FX Evolution Trading Discord as well. So if you want to get access to that, we have a free trading cheat sheet, and you can just sign up for that. Tyron will put the links in the room now, and you can get the cheat sheet, and you can also get the Discord where a lot of public members discuss current setups. So what are we going to be covering today? Well, there's a few things. Firstly, we're going to identify how and when a market is range bound. One of the hardest things to do as a trader is to identify either markets trending or range bound, and when you should be in and when you shouldn't be in certain market conditions. Then we're going to be looking at live chart analysis of forex, indices, and gold. Favorite, gold has been an amazing investment if you've been long for the last couple of months. So we'll be talking about that and talking about the ranges actually that have been formed in that, because there's been some good trades in the range. Then popular scalping indicators for MetaTrader 5. One of them I'll already mention it. Stochastic is a popular one, and for good reason. It pays off in dividends when it comes to trading it within the channels. And then of course live Q&A with our team. We'll answer questions along the way. So if you do have questions, feel free to make sure that you basically ask them throughout this webinar, and then we'll answer them as if they're pertinent to, I guess, the current discussion we're having. One thing I want to mention, if you're a scalper and you're not aware of the news that's coming out, it's very important to be aware of this news. You need an economic calendar as a forex trader, indices trader, or any kind of real instrument. Unless you're trading soft commodities, that's a bit more weather related. But here we have a news event calendar, and usually they'll look something like this. So you'll usually have like red news, and you'll have yellow news and orange news. I'm sure many of you are aware of this. When it's red news, if it pertains to a currency you're looking at, so let's say we were trading New Zealand dollar and we were seeing a cash rate, it just makes sense we might not want to be scalping around that time. Now, are there going to be bigger moves around that time? There certainly will be, because news is coming out. The problem is a scalper will generally be on the smaller time frames, 1 minute, 5 minute, 15 minute, maybe upwards of kind of day trading range on an hour. They're not going to have very large stop losses, and you have a chance of being gapped or stopped out by the news, and it can be kind of the deal breaker of your accounts. I mean, Tyron, how many scalpers do we know come undone by news trading?
Yeah, and it's generally because they're not trying. It's not so much that they're even trying to trade into it. Most of the time, it's just because they're not aware that the news is happening, and all of a sudden the market just spikes 20 or 30 pips either side. And quite often when you are scalping, I mean, that's probably the length of your stop loss if you're not on the right side of it. So it can happen very quickly, and just by simply knowing and just identifying when it is going to be released, you've just got to mark it, even on a piece of paper near your computer, to know what you're going to avoid, or the time frames that you're going to avoid. It's only got to be half an hour each side. You don't have to avoid the whole day or anything silly like that. It's just basically, if you give it half an hour or 20 minutes each side, that gives the market time to settle down. People do trade the news and they try to, but it is really a guess. Anyone who says they successfully trade the news by scalping is just getting lucky, really, because nobody knows which way it's going to go. It's an absolute guess.
Over a decade of data, it's going to be very hard to prove that that's a successful strategy because of the nature of the speed of the markets. So which trading pairs do we want to start with? Well, we love to trade the big majors when it comes to scalping, things like gold, odd majors, euro majors, US dollar majors, pound majors, all of these types of ones, and of course the crosses and everything like that. So some of these are some great ones to start with. In terms of times to trade for scalpers, well, one of the best times to trade is into session opens. We talk about this all the time. Obviously, you're going to have range-bound markets. Often ranges begin and stop with sessions. So what might happen is you might have the Asian session where there's a bit of action around Sydney Open, Japan, China, all of those kind of markets opening, Singapore. And then there'll be like this afternoon area where it will die off, and into Europe and into London, you'll start to see volatility come back into the markets. You might have a tight range, a tight channel on the 5-minute or 15-minute markets that breaks out during London. So if you're a scalper that's looking for a bit of a breakout, one of the best things to do is to look for session opens. I personally think that London Open is one of the best ones for that. And it's good to get in around 30 minutes to an hour before the session, as sometimes it breaks 15, 20 minutes before actually the session starts. So that's something to look at. Now, I think the best place for us to start is actually, before we get into the live markets, just talk quickly about what we do here, which is the top-down approach. And that is to basically begin on a higher time frame, begin where the big money is, begin where Goldman Sachs and JP and all these kind of people are actually investing up and down in the forex markets or indices or anything like that. And then work our way down to try to find key areas of support resistance where we can then ascertain, okay, we're in a range, let's get our range indicators out, let's get all of the reasons we want to be in a trade out, and then we'll start to trade. And we also want to use lines, bars, and candle charts. We don't just want to use one of those. So what does a range-bound market look like? Well, it looks something like this. Obviously, we're going to have a range of the candles, we're going to have resistance up the top here, and we're going to have support down the bottom. So let's draw that out right now. Now, how will it look on different time frames? Slightly different. So here we have a 4-hour chart, and look at the way it looks like. We've got this red resistance line up the top, and then we've got this green support line down the bottom that we've drawn. This is how it looks on a 4-hour chart. Now, if we're a scalper, we obviously want to be in the smaller time frames. How does it look on a 1-hour chart? Well, if it looks something like this one does below here, Tyrone, what does this tell us about the way that this market's ranging? I mean, this is perfect, isn't it, for a scalper?
It is, and when you do drop it down to an hour, I mean, an hour is pretty a good time frame to go for scalping, but generally a lot of people go even smaller than that, so to the 15-minute and also to the 5-minute. So if the hour is giving you the series of higher highs and higher lows that you can see very clearly on the 1-hour chart there, and that this is the exact same time frame, so you can see that all the dates match up. It really gives you an insight as to what sort of an opportunity that you can get to basically trade. Trading the channel's range for starters, so you can basically you can see here the highs and higher highs and high lows are being drawn. They pop up through there, and you can really see that in price action. It happens a lot. So when you do break it down, if you took this down to a 15-minute chart and broke it down again, you're going to see even more opportunities to get in and out. And that's why we say when we're talking about scalping, when you get an opportunity to actually see where the predetermined range is going to be, you've got very clearly defined take profits. A knock on scalping an open market where there is no range is that, yes, it's all good and well to trade with a trend and go long when the market's going long, but at some point it is going to collapse on you, and you're not going to know when that is. Are you getting the last wave before it turns around, or are you getting the second to last wave? You don't really know because there's no clear direction. But the good thing about having a range-bound market is that you know where the steam is going to run out of the market. Now, could it break the top of the range? Well, of course it can, but more than likely it's going to find some pretty good resistances. So you certainly don't want to be preempting that it's going to break that range if you are trading inside it. So that's the great thing. You do get notice and plenty of it before the market's going to run into real trouble when it loses momentum.
So when it comes to trading in these ranges, how do we define it? Well, one of the ways is we can look for touches of each side. So you obviously see a channel after the fact, and a lot of people will say, well, it's obviously a channel. It's obviously range bound. We're interested in trading it. One of the easy ways to do it is just look for 2 touches of each side, or at least look for some kind of definition. So we have a touch down here to begin with, then we have a touch at the top, another touch of the support, and when we have that second touch of the resistance, what it's really showing us here is that we're in a range and the market has found 2 fair points of value. So as I said, let's get into the actual charts and actually talk about something that happened recently with gold. I also have a great question here, Ty. I'm going to answer this right now. I know you already have, but it's a question. Does it make sense to do fundamental analysis if you are scalping 30-minute or 1-hour timeframes? The answer is no, unequivocally no. Fundamentals work, but obviously they are huge in currency. You are talking about an entire country's currency, and there is a lot more intricacies to it. It's a little bit different to stock from that aspect, and I would say if you're scalping, you want to purely be looking at those technicals. That is what scalping is about. It's really not about the other kind of thing. So when we're talking about ascertaining top-down approach, let's look at this gold for a moment here. Now, I'm pretty sure no one will say this is in a downtrend right now. It is clearly in an uptrend. We are seeing the market go up very heavily on the monthly. And you're probably thinking, why are we looking at the monthly, Tom? That's crazy. Well, then when we break it down and we look at the weekly, again, we can see very clearly an uptrend. When we look at a daily, very clearly in an uptrend. It becomes very important because as we're trying to figure out, let's say if the market was range bound, and it was very clearly range bound literally only a few days ago, when we know the direction of the overall trend, we know how the market has been interacting with that trend. Look over here, we have many touches of this 50 moving average on the way up. Notice how during the channel, it also is touching this zone and finding support on the way up. The reason this is so important is because if we're trading with the trend, the bigger time frame trend, and we're trading the range, so when we recognize that range bound market in the direction of trend, do you think that's going to be stronger or weaker for our scalps? It's going to add extra percentage statistical chance that we're going to be correct because we're trading where the big money flow is. That is really something that I believe separates kind of a beginner trader to an intermediate to more advanced trader. Understanding that if you're trading ranges within the direction of the trend or you're scalping within the direction of the overlying trend, your success will be higher. Ty, how important is that? Massive, it's massive info.
Absolutely. When you are trading in the direction of the trend in any circumstance, it's always going to be easier. So, it stands to reason that if you are doing that inside, even though you are in a range-bound market, if it is still going in the direction of the prevailing trend, you're going to have the market power and the market momentum with you. And that may not seem like a big deal because you might think you're only going for, 15, 20, 30 pips here and there. But believe me, it makes a big difference when it comes to the time where the market starts to run out of gas and it starts to rely on the bigger time frames to push it through. So it's never a disadvantage, let's just say that. And you always want to be taking every advantage you can in trading because it's not obviously the easiest thing in the world to do. So you want to take every advantage that's afforded to you, and trading with the trend will never cause you a disadvantage in that regard.
And there's trends within ranges. Obviously, we're talking about ranges, but what trend came into that range? Pretty much a range is the final step of kind of the process of getting to that area. It's where if you look at the kind of market cycles, the market is having a rest before the next move. Now I've got this up here, and the reason I bring it up is because when we go down to, notice over here, it was the 1794. When we go down to the 5-minute chart, we're still at the 1794. And I want to explain how this area here is an incredible price action based trade. There's a few things breaking down here, and also break down our stop losses and take profit levels for this kind of zone. So one is the key amounts of resistance. So do we want to be buying down here? Ideally, you actually don't buy this zone as a scalper. Most people will. Most people will say bottom of the channel, I'm buying it. It's okay, but when you go back over history, it's very easy to see in spot channels. The better thing to do is to wait for the confirmation of a change of trend. So here what we have is we have a ton of resistance that is being met. And remember, the top of the channel because the 5-minute chart is well higher, many dollars higher. So we have so much resistance that is broken through in the direction of the overall trend in our range. So we have a very good idea of where our take profit should be. And it breaks through and then comes down and tests those moving averages. Now we've got 2 moving averages here, and you can use the moving averages on the smaller timeframes within the channel or the range bound market. So here we have the 20 exponential, which is the red one, and the blue one is the 50 exponential. And the market's come down and it's basically tested this previous resistance, which becomes support at the same point as we have oversold stochastic. And this is the type of trade that if you get into this on a 5-minute time frame, not only do you know it has hit the base, because the key support on the bigger time frames is down here at 1794, but it is thought about this level, it has broken this level. And what's the beauty of knowing you're in a range bound market? You're knowing that it's going to most likely gravitate towards the top of the range. And when it does that, that also brings in, even if you miss, let's say, this first entrance, let's think again about what the market's telling us. Resistance has broken, it really tested it. When you're in a range, where's it going to gravitate to? Top of the range. So once it starts doing this and it respects that 50, notice how it respects the 50 once here, it respects the 50 twice here, it respects the 50 3 times here. It slowly, a little bit breaks through here on the 4th, but it continues towards the top end of the channel. So you get multiple entry criteria after seeing something as key as this, because you know once it does this, it's going to gravitate up.
Yeah, that's so important. And look, it really highlights an important point. A lot of people really want to try and pick the bottoms and tops of channels to actually do their scalping. But in reality, when you are trading the bottom of a channel or the top of a channel, even though you know it could be potentially range bound, or it has been range bound in the past, the problems that you're going to encounter is what we call, and what everybody calls really, fake outs. Now, the problem with fake outs is they generally push past where people would otherwise have a pretty reasonable type of stop loss in place. So if you were attempting to scalp where Thomas first suggested down at the bottom there, you're going to have a bigger stop loss than you would ideally want to survive a trade. Now, when we're scalping, what we don't want is a big stop loss. Obviously, we want to be having our stop losses fairly active with what price is doing, so very dynamic. And the only way to do that is to be able to actually understand where the market is moving. So rather than trying to pick the bottom, like we suggested here, if you wait for it to actually pick up, a 20 is a great reload zone. Okay, that's the #1 rule. We talk about it all the time. It's one of the best places to continue a trend. So when it pulls back to the 20, you basically jump on. Now, the question we get asked a lot is the 20 always reliable? Do you always jump on it every time it touches it? Well, no, the answer to that is absolutely not, because when you look at it, we'll go to the first one. So at the very bottom, there, so you can see we've got the arrow drawn right there. That's the first reliable 20 touch. Every one prior to that, even though the market touched the bottom of the, even though the market went to the bottom of the channel and went up and crossed the EMAs, we would never rely on that 20 EMA any earlier than that #1 arrow there, because quite simply, it hasn't had a chance to test it yet, and it hasn't given itself direction. So, like I said, what we want to be trying to do here when we're scalping is keeping our stop losses sensible. I'm not saying we have them really tight, so we're really hoping and praying that it doesn't come down. But we want to have proof that, one, the market is trending in the direction that we think it's going, which is in the range's direction, but also that moving average has already had a history now of actually providing support. And when we know that, and it's done that now at the #1 and the #2, we could have taken the #1 because obviously it's already started to make the series of higher highs and higher lows. Now we're drawing some stochastic arrows that are coinciding with these moving averages. Just for people who don't know, stochastics is a momentum indicator that effectively compares the closing price of whatever trading instrument you're looking at to the high and the low range of its price over the last 14 periods generally, which is the standard. So what it's basically doing, it's working on momentum. Now, when we see it going into the overbought and the oversold zones, as what the 70 and the 30 lines indicate as a standard rule, that's when we're seeing that momentum is starting to be extended. So that's where we're looking out. When we're looking for a pullback, we're going to expect that the stochastic is going to be in the oversold zone. When that does coincide, you can see there the cross happens underneath. market comes and tests the 20 moving average, off we go. Now, we did have a question a little bit earlier about where we would put a stop loss for a scalping strategy. And it probably might be not a bad idea to address that now. What we're doing is when we're primarily using the 20 moving average as our entry point for scalping, and it is a very, very good one, make no mistake. It might sound simple, but it works very, very effectively. What we like to do is usually put the stop loss a handful of pips, probably about maybe 5 to 10 pips, depending on what time frame you're trading, behind the 50. Okay, so the 50 generally tracks up, as you can see, and then if we put the stop loss behind it, that usually keeps it tight enough to give us generally a 1-to-1, 2-to-1, maybe 3-to-1 trade. So that answers another question that I've got there as well. Generally, when we're scalping, we're looking for 2-to-1 ideally. But sometimes you can get the 3-to-1s if you really capture a good trade. But quite often, you'll find yourself entering several times in a period like this. You could have 3 or 4 really good trades.
So let's say it hits a moving average that you've got in your charts. And let's say you don't want to use 20 and 50 or whatever. What you can do is, as Tyron said, we might put it 5 to 10 pips. Never put it 1 to 2 pips behind. That's not going to be enough, unfortunately. The beauty of trading within this range, we're trading a bigger pattern. Remember, we're not just scalping randomly with something that we find. We're scalping with the concept of the market knowing that it's going to gravitate towards the top of that range, top of that channel on the 4-hour, and we have a lot of room to potentially be making money. It's very important to understand the higher time frame so that we can make more money from our scalping position. So one of the things I wanted to bring up is notice how our line for the top of the resistance is actually up here at 18.15. Notice how it stops just before. That's because if we were trading on the higher time frames, let's say we were trading on a 4-hour, what we would usually do is we would say whatever the range is, so whatever the distance between these two zones is here, we're going to take, when we buy it at the bottom, we're going to take 70% of our expectation. So basically, if this is your full range, you're saying, I will not take the full range, I'll take around 70% of it. So you can apply that to your scalping as well. You can go back to the 5-minute, 15-minute chart, find the trend in the direction as it's going up. It's usually going to be relatively aggressive. The reason I keep mentioning those 1, 2, 3, 4 kind of touches is because that's showing us that that is a respected moving average. So the 50 has been heavily respected here on the way up, and then it hits the final time up here, respects it, comes through, hits the 70%, and then sells off. There's quite a few kind of stop outs though up in this area. So there's a lot of profit to be made here from a scalper. You only need to have your stop loss a few, maybe 5 to 10 pips behind, but overall you're looking for a lot more profit because you understand the higher time frame. That's the difference. It's having that. I know that when I first started on 1 minute, 30-second, 2-minute charts, all those types of things, I wasn't looking at the bigger time frame and understanding there's a lot more profit in this trade than you usually would expect when you're just buying and selling. And when we're going with that direction of the trend, we're going to have even more success usually, which is great. So let's get back into the slides and just talk about one other thing that I think will help everybody out, and that is to understand patterns within a range. So many people are probably familiar with things like double bottoms, double tops, those type of things. They usually come with a 1-to-1 risk reward, where effectively you are buying as it closes past this intervening trough and you're taking the distance. Now, these are great kind of patterns to be looking at within the channel. So if we recognize, let's say, a 4-hour channel, and then we're on a 15-minute chart and you see a double top at the resistance or a double bottom at the support, guess what? It's a change of trend kind of pattern that's showing you that that has found support or resistance again, and it is most likely going to gravitate to the other side of the range. So that's very, very important to be looking at, something we want to be doing when we're doing these scalping kind of moves. So what other things can we do within the range? Well, when we understand double tops, double bottoms, those kind of things, we can even trade aggressively within the range because we know, again, there's no trending market. At this stage, it's having that kind of sleeping period where it's ready to get ready for the breakout, but we're not seeing the breakout yet. So Ty, do you want to talk us through this one? He may have dropped out. I'll talk it through this one. So basically we have a resistance
Sorry,
up here at the top.
I'm back here.
Oh, yeah.
I was just answering the
Okay.
question. Yeah. So
Okay.
what we see here is basically the potential double top aggressive entry scalp. It's one of our favorite scalps when they do present, because quite simply what you're looking for, a lot of people don't realize that actually, although double tops and double bottoms are reversal patterns, they're best actually traded when they're actually in the direction of the prevailing trend, or in this instance, in between a range-bound market and actually going in the direction of where the next price movement will be, which in this case is going down to the support line. So when you can identify them, what you want to be doing here is preempting the double top, and basically, so you can see P1 there, and you can see the red cell circle on where P2 would be expected to go. Now, what we're doing here, although we're preempting what a double top will be, we're not actually trading the double top. We're just trading the potential of it as a scalp. There's a lot of things going for that, and it might sound like you're probably having a bit of a guess as to whether it would actually play out or not. But when you think about it, a lot of people are actually looking for that pattern to work out. So what we're looking for in this instance is a series of candle patterns that are going to give us the indication that it is going to give us the second P, which is the second peak of this head and shoulder, of a double top. Any of these 5 candle patterns on a smaller time frame at P2 would give us a signal to scalp this down to the neckline, or what would be a neckline if this double top was to play out. Now remember, when we're in a range-bound market, the price is being pulled and gravity is pulling it down to the next support zone when it's on its way from the top. So it's got a lot of things going for it, and what we're looking for is that distance down to the neckline. Now, you must be mindful that this is a scalp and not a double top trading pattern that you're going to try and break the neckline and go all the way down to the support line. That's a different trade. And simply all that means is you're actually using a very different stop loss for it. And that's the difference, okay? When you're scalping this, you're going to have a pretty aggressive stop loss. In fact, your stop loss is going to go, just for the people who did ask that earlier, your stop loss in this instance would go about 10% of the expected move above the candle pattern that you saw. So whether it's a shooting star, a bearish engulfing, whatever candle pattern you use at that level there, okay, you work out where the neckline will be, which is the trough that separates the 2 peaks. 10% above that, above the candle pattern, is your stop loss. So generally, these can definitely give you a 2 or 3 to 1 risk reward ratio. But because that stop loss is a relatively tight one, because it's a scalping stop loss, that's why you're not attempting to try and break the neckline and go all the way to support. That's really going for glory. That's actually a different trade. If you want to do that, you've got to put your stop loss basically in the same spot, but you're entering at the neckline. So it is a very, very different scenario there.
Okay, thanks for that, Ty. So there's obviously multitudes of different ways of trading within these ranges. I just want to go back over to the range and we'll just talk about what we've seen recently on the Aussie dollar. So let's just go to the Aussie dollar, go to the 4 hour and bring that down for a second. So we've got the line chart. All right, and here we go. So one thing is we actually have had a range within a range. So if we go to a daily using the top-down approach, you'll notice that there was a strong resistance here at the psychological 70. Then there was some support down at the 68. Big range. As a scalper, maybe it doesn't interest it too much, other than we know it's coming to the kind of end of that cycle and it's having that disbursement. So when we then go down to a 4 hour, notice this over here. Notice this very, very nice little channel. When we see a channel like this, we can then break that down into our smaller timeframes. Now, if we go and look at the Aussie, we would know that the daily timeframes were saying bull, 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 bull. Every other time frame was kind of saying buy, 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 buy. When we break it down and we've got the range here, we can be doing a whole bunch of different things as a scalper. One thing is we're going to be more bullish than bearish, because in this case, we know that while we're in a range, the overall trend is up. Look at this, very similar than before. One of the favorite things that I have is always to look at these kind of breakouts where we've got those multitudes of touches. Very similar to the gold before, and very similar to really any of these types of things. Whenever you have like 1, 2, at least 3 kind of resistances, and then it breaks through those zones, what I like to do is I like to break down that and say, okay, well, we've clearly found support at the bottom of the range. We've tested the area very, very well. And then what we're doing is we're trying to pick it up. Now you can either take a close breakout or you can try to take the pullback to the zone. So here we had a very big sell-off that came almost back down to the neckline here. It just quite didn't. And then a bull reversed off that. If we go into the smaller time frame, there was quite a few buy zones here. It hit that 20 that Tyrone's been talking about, and it quickly went off up to the range. Again, the power of understanding the range bound is understanding that yes, we've missed out on this opportunity because we waited for the confirmation that was going the other direction. But when we see strong signals like this, we know there's a high chance it goes 70% of the range in the upside, and we can take scalps towards that upside. And that's what happened very, very quickly. So you can break this one down as soon as you see a breakout of this section here. Another thing that you can do, if you don't see, let's say 3 or 4 or 5 touches in terms of the price action, then a break, what we might see is something like this, where we basically just have a trough, a peak, a higher trough, and then we see it break to a higher peak. When that happens, we can be looking for buy sides again to the top of the channel. We just then say, okay, we know it's strong, we know there's buy sides, let's go look for strong signals. One of those signals, what do we get straight away? Bullish hammer down the bottom here. We get bullish hammer over here. It just gives us that bias that the support is in, and now we can be looking for 70% up to the top side. And that's the importance, I guess, of understanding that you don't want to necessarily buy the support. You want to buy once you get that change of trend on the smaller time frames.
Definitely.
So,
I've just had, I'm getting quite a few questions about looking at the market and wanting us to look at some certain pairs. We've actually, our webinar that starts in half an hour actually does that. So I've put a link in the chat window. So if anyone who'd like to join that, if you haven't registered for the next webinar that starts in half an hour, that's our live market analysis webinar where we'll be talking about the concepts that we're talking about here, but in live markets and doing some pair analysis. So just look out for that one, because we've got a few more things to get through on this one. We can't really go to the live markets for individual pairs just yet.
Yeah, so we've talked a little bit about recognizing trends using price action, understanding troughs, peaks, troughs, high troughs, etc. When you do this within a range, what you're doing is you're basically confirming that the support is in or the resistance is in within the range, and then you trade it with the high probability that it's going to go to the other side. So that's the best thing about being able to read price action. Now, when it comes to ranges will always be broken. This week, we've seen ranges get broken, and they've been aggressive, and they've been very good scalp trades or very good day trades. So types of strategies for scalpers, well, when we're in a range, obviously, we need to recognize that support and resistance, and then we need to recognize either a change of trend or a multiple break of resistance, or as Tyrone was saying, a double top or a double bottom within the range. All very good price action bases to then bring your indicators on. Well, what about channel breakouts? Well, they can work out very well as well, or roll reversals back up to the range. So if you understand roll reversal where resistance becomes support or support becomes resistance, we'll assume you do today. And it looks something like this. We use the slides all the time. And basically, if we go back to the market quickly and we go to the US dollar CAD and we go to a 4-hour, what you're going to notice is that there was a very strong breakout of a range. Literally, it broke out of this range. Now it's selling off right now, but what will often happen is, again, this is a 4-hour. Sometimes you'll see the market come back up, and it will generally come back up to the conservative entry. The importance of understanding the 4-hour for our scalp is to know that this is a clear range break. We have a clear range break of support, and when it comes back up to this section up here, let's say the 20 moving average on the 4-hour, we can go into the 5-minute and 15-minute time frame. And guess what we're looking for? Change of trends. We basically look for the change of trend to the downside, and then we can scalp within this downside down using stochastic with overboughts, and we know that it's going to hover and gravitate to the next section. So think of it as it comes back up to this zone, it's broken the range. What's the range telling us? The distance of the range will most likely go again. That pushes it into the previous level of support. And we can literally highlight this zone and then go and set alerts on our smaller time frames and start to trade it. If that happens before a market session open, even better. So that is a very, very important thing to look at. When you see range breaks, you can go back into the smaller time frames, look for the conservative entry on the bigger time frame, and then scalp those bottom ones, and you'll get some very high rewards in terms of these types of trades.
Yeah, and that was a very, very serious break on the CAD there too. Yes, like that was a very, very serious break. So you know,
Yeah.
I would expect that would be going up there and testing it, and yeah, could provide some really good opportunities.
So one thing with scalpers is it's very hard on our psychology as traders. So I always have this one up during the crisis because obviously when it comes to trading, everyone's probably felt every one of these emotions, the optimism, the excitement, the euphoria, and then all the way down to the despondency and the depression that comes with sometimes being wrong. So it's okay to be wrong as long as we learn from our mistakes. So we have to always try to be being better. And the problem with trading is it's very hard to know statistically whether you've made good decisions or bad decisions. Usually you'll know because you'll just be at one point just clicking buttons and not really having a plan. So having a plan is really important when it comes to trading. And when you're recognizing those ranges, why don't you just have a plan of saying, okay, when I see 2 touches of both sides, I'm in a range market. 2 touches of resistance, 2 touches of support, we're in a resistance support market, we're in a range bound market, bring out the range strategy. By just making that one key decision that you're going to keep statistically using over time, you'll know, well, firstly, it makes sense because if you get 2 touches, you're testing the market, but you will be able to have a much better experience of knowing, okay, I've got this one solid thing, and then I'm going to add extra things over the time. You don't want to be always changing your system. You always want to be thinking, does it make sense? If it makes logical sense, it's probably going to work over the long term. And it brings me to confirmations. We always want to wait for confirmations. A lot of people, when you're trading, this is the common one, is you'll come in and you'll see, let's say, common thing that scalpers like to do is they like to look for bullish hammers or pin bars. So they might see this, and let's say this is a 15-minute chart, and we're 30 seconds before the chart closes. Now, it might look like this, but then 30 seconds later, it looks like this. The only problem is we bought this thinking it was a bullish hammer and we lose some money. So what we don't want to be doing is doing that. Easiest way to do that as a scalper, put a trade after it closes 1 to 2 pips above the candle confirmations. Even if you're looking for any kind of candle confirmations, 1 to 2 pips above will stop you from making a mistake of getting in too early. You'll also know that the market continues in the direction. Now, I understand for a lot of people, 1 to 2 pips might even be their profit. I think it's important to know that, look, scalpers can take 10 pips, 15 pips, 20 pips. Try to get a system that doesn't rely on 3 to 4 or 5 pips. The problem with that is you're going to be very reliant on, of course, spread, and you're going to be very reliant on everything going right. There's too many variables that can go wrong, news, all sorts of things. They can really crush your account. So
yeah, spreads can widen. Absolutely, spreads can widen so quickly, you know, and news does widen them, as we all know. Look, there are better ways to scalp than going for, you know, 3 or 4 pips. Like I encourage all of our students to never go under 10 as an absolute minimum. No one would dare bring me a trade that they tried to take with under 10 pips because they probably would know the response. But there are so many trading opportunities. You don't need to go that small. And when you take that the spread out of the equation, you know, the thing is what a lot of people do is they automatically assume, because they're scalping, that they're going to have to make fast decisions on the fly, not wait for candle closes, not wait for confirmation, because you've got to be quick and you've got to be agile. You know, yes, you do have to be quick and agile, but you've got to be quick and agile in the right way. You always wait for confirmation, just like that candle there. That hammer candle would look very, very different, just like it did it. We'll just redraw it. That is a very, very bullish candle, and what it can turn into if you don't wait for that close can be a very, very, very ugly candle on the way down. And that's what can happen. So just because you're scalping, it doesn't mean that you rush, okay? You want to be still waiting for the candles to close. And that's the whole point of, you know, not going for, you know, 2 or 3 pips here or there. You know, structure your trades. You saw in the examples that we've given you tonight, like they're all, you know, 15, 20 to 40, 50 pip trades. They're not going for only a handful of pips. So the opportunities are there and they're everywhere. That's only just one example. So what you really want to be doing is making sure that you've got enough movement in there that you can wait for a candle to close, wait for the confirmation to price, to show you that it is going in that direction, and you can scalp with a lot more efficiency that way.
So one thing, I've got a question here. Does this type of thing work in indices? It absolutely does. It'll work in indices, it'll work in commodities, it'll work in currencies. The point is that you're recognizing the market range bound based on the channel method, which is 1 or 2 touches each side. Once that happens, of course, with indices, they are generally long kind of markets. So if you're looking more at the buy side of the channel, usually if that's the trend, then that will be more successful for you as well. And it all goes down. It's that top-down approach. Like if you recognize the trend, trade the trend within the range, even though it's in a range at that point, you'll find just a higher statistical percentage of chance of winning. If that's 3% more, it makes a difference over hundreds of trades that you're going to make, if not thousands of trades over the next couple of years in your accounts. And this just comes from experience when trading the markets. In terms of things like leverage, someone is asking, what about leverage? Is it good or not? Leverage is fine as long as you use it correctly. So that is absolutely no problem.
When you know what you're doing, leverage is definitely your friend. But if you don't know what you're doing, leverage is going to be your jailer. I can guarantee you that. So, and look, don't think for a second that you actually have to have 500 to 1 leverage to be able to place the right risk rewards on your trades. You can get away with a lot smaller than that. Another question that was there, but it's probably got a little bit to do with leverage as well, was what sort of an account would you start with that would be ideal? Now, that is a good question, and really that is relative to how much you're going to risk. If you're only risking the advisable 1% at the start, if you're only just starting out, I wouldn't even start at 1. I'd be starting at 0.5%, because you've got to be able to keep your trades in check, but be able to sustain. Scalping is going to give you losses. There's no question about that. And you could get a few in a row before the direction goes right. So you want to be able to risk the right amount where you're going to be quite comfortable. It's not going to damage your account. So it doesn't really matter whether you're starting with a $500 account or a $5,000 account. Really, when you're risking the right amount, the trade is exactly the same.
So I just want to go back to that Aussie again, just show that 5-minute, just to quickly talk through this point here. So look how clear this resistance is at the bottom. I just want to say, when it breaks through here on the 5-minute, you could absolutely buy this. Let's say you were breaking out the buy. You could do that. You could say, okay, breakout has happened. I'm happy with the direction. I'm happy with everything, and I've done the confirmation. I just wanted to point it out because look at if you place the stop loss behind the last level of price action. So we're talking before about how moving averages are a good level. They are a good level when you're in the direction on the uptrend. But if you can recognize using price action where you should place stop losses, you'll generally have more success. Remember, when you trade like this, you're probably looking at that scalp at least going 70% of the upwards channel, so at least going up to this point here. By doing that, you're going to be in this trade, it looks like, for about an hour and a bit, and maybe 2 hours, and you're effectively saying, okay, we're going to place it underneath the last swing. We're going to risk this much, and the reward is this much. So we have quite a lot more reward. The other option is that we wait for the conservative entry. So we wait for it to come back down and test it. And often on the conservative entry, you're going to get this. So you're going to get a oversold stochastic. The beauty of this, where do we place our stop loss? Well, I still would be placing it underneath the swing just because of the nature of the profit and everything. But you can also sometimes just place it underneath like a moving average, dynamics. Maybe this was going to be the 20 moving average. You can place it under the 50 by an extra 5 to 10 pips, like Tyrone said. You're going to have a few different scenarios for stop losses, and you want to build those into your trading scenario. So you want to say, okay, sometimes if I'm trading within the range and I'm using the moving averages, if I see it hugging that 20 on the way up and I'm buying the 20, the 50 plus 5 pips or plus 10 pips is always going to be my stop loss. If I'm waiting for it to break through the resistance on the bottom of a support and I'm waiting for this level, I'm going to put it behind the last swing. Use that consistently over time. You'd be surprised how well those kind of moves work. They're being market adaptive. What you don't want to do in scalping is say 5 pips every time I use a stop loss. That's not very good.
Very
you don't
cool.
want to do that.
Yeah, you don't want to be doing that. Or risking $100 per trade, but only giving it a 4 pip stop loss. You don't want to be doing that. Even if your risk management is right, you're going to get done every single time.
So I'll answer the question about the best time frames. I think one of the best things to do is go 4 hour for your channel recognition into 1 hour, or 1 hour or 4 hour. Find your channels. use your day for your trend, just so you know the direction in general, so you can have that bias if you want to have bias within range. And then you want to be scalping 5 minute, 15 minute up to the hour candles. I actually don't really suggest 1 minute. I know it's where people like to sit, but 5 minute, 15 minute, the lower the time frame you go, the less consistency you're going to have and more fake signals you're going to have due to the nature of where the money's moving. And the money moves on the bigger time frames. What you're doing on a 1 minute doesn't matter on the 4 hour, it really doesn't. So I'd probably say 5 minute is as low as you should go, and then try to stick to that 15 minute and 5 minute up to hour. If you do that, amazing how good that can become. So Tyron, look, we wanted to mention this just because we're doing it for now, and that is that we do have a course that we offer, and we do have like a private Discord community where there's hundreds of traders in there that trade forex and commodities and everything, share their ideas all the time. We do have 50% off, and this is all changing as of the end of this week. So this will be the last time we ever offer this one. It was obviously our lockdown special. It was 50% off. We'll put a link in the room if you like what you saw tonight and you want to know more about swing trading, day trading in general, specifically price action based trading with a little bit of indicators built into it, and having a plan all the time. We have a very good strategy on the plan, and we specifically love day trading. So day trading and swing based trading, if you're a fan of that as well, you should definitely check this out.
Definitely. Currently, the access to the room gives you full access to the Trading Essentials course, which is our full technical analysis course. That is going to end on Sunday, and that is never ever going to be repeated again. I can promise everybody that. We've made that decision firm. So everybody who's got it now and everybody who gets it before Sunday is going to have it for as long as they're members. But anyone forward of Sunday night is not going to have access to that course. So if you have been thinking about it, and if you're on the fence, the next 3 or 4 days is definitely the time to do it, because you're getting extraordinary value really for basically what it would cost you to be in the room anyway. Now also, Pepperstone are putting out a poll after this webinar to just help with the feedback, so how we can make our webinars better for you. So if you could just take a few moments to fill it out at the end of the webinar, it would be greatly appreciated, because that data is really, really useful to plan our webinars moving forward, to make sure that we can tailor them to what everybody wants and really be very specific.
So I've got some questions here, Ty. I'm going to answer them now. One of them is my take profit is 2 to 5 pips, but out of that, about 0.7 pips of value is commission. What should I do, and should I have bigger targets? Look, you should have bigger targets, absolutely, but that means that you need to be assessing those bigger timeframes to realistically have the bigger targets. It's important that you know what the bigger timeframes are in terms of resistance, support, know where a take profit could be had, and then you can go up. It's really not the best to be relying on 2 to 5 pips, as we said, just because, look, we've done it. I've done it over time, and it's more like an algorithm kind of thing. If you were running like an algorithm or a robot, then you can be quickly in and out. But when it comes to hand-based trading and actually understanding the psychology of those zones, it's probably better to try to make those ranges bigger. So that would be the answer there. Tyrone, we've got some other questions here.
Just the webinar is going to be recorded, and it will be available for everybody to watch on the Pepperstone YouTube channel tomorrow. So generally about mid-morning Australian time, it'll be up for everybody to be able to watch the replay. So if you've missed parts of it, or you want to just review what we've done tonight, it's definitely going to be on tomorrow, and you can watch it anytime you like. And to answer a question that's been asked about a million times tonight, the moving averages that we use, the red one is the 20 EMA, the blue one is the 50 EMA, and the 200 is SMA. So that's the green one.
I'm going to answer with this summary that I think probably is a good summary for tonight for everybody. Okay, how to scalp the ranging markets. We'll summarize it by saying trade in like the direction of the bigger timeframes, because generally the range that you're seeing will actually just be the final phase of kind of that trend. It's very important to understand. Then you want to trade in the direction of the EMAs, that would be good, and the smaller timeframes after seeing the change of trend from the bottom of the support or the top of the resistance. And then of course, if we follow our scalps with a nice moving average, like a 50 EMA or a little bit more with a few pips behind, usually 5 to 10, that will help us out as well. So there's a whole bunch of different things, but recognizing patterns within patterns is going to be one of the keys that you bring out of today. And of course, using stochastic effectively and adding MACD later on. So we've done some MACD ones. Go check them out on Pepperstone's YouTube channel, and hopefully that helps you out. So we hope everybody enjoyed today's session. We might see you in 10 minutes. Otherwise, we'll see you in 2 weeks' time, I believe, Tyrone, and we'll have another great topic to discuss with everyone. Thanks very much.
Sure will. Thanks, everyone. And yeah, please fill out that poll at the end of it so we can get some good feedback and get the next topics in line with your expectations. Thanks, and have a great night.
Yep, last one I'll answer. Just economic calendar. When should we stop scalping or before? You should stop scalping so that you get out at least half an hour before, because a lot of position sizing comes in around that time. And then when it comes to closing out at the end, I would suggest that you at least wait for an hour for the news to cool down. Sometimes non-farm payrolls, you might need to leave a bit longer. Thanks very much, everybody. We'll speak to you soon. Bye.